Hey everybody, this is Uncle Gary, and in this episode we're going to cover off how wrong I was about a prediction I made on December the 7th. I'll put a video up here above my head so you can go back and see it if you want to, but I made a prediction and I got schooled. I'll tell you what positions I took, how much money I lost, so please go ahead, like and subscribe this video. I put myself out there, it did not go well, so I'd love you to find out why. That's the key learning here. Click on that little bell icon and it will alert you to the next videos which I'll be putting out on Bitcoin, Tesla, what's actually happening, and we'll be making a lot more options videos. Let's go ahead and jump in. So in this video, I'm going to post an update to a video that I posted. I'll put the link up here for you. On December 7th, I posted a warning that the market was due for a correction and that it could be severe, upwards of 20% drops. And what I saw was all of the evidence that I put in place, and my hypothesis was there were three really primary reasons why I thought this market would shift, and in reality I was 180 degrees wrong. To put it mildly, the markets have hit all-time highs well in excess of what I was predicting. My prediction was off. And worse than that, to make it even harder to come clean and tell you what actually happened, is that I even made some trades and I lost money on them. I got schooled by some of those trades. But this is the nature of the game. First of all, there's nothing wrong with making predictions. You do your research, you come up with a hypothesis, and then you play the round. Sometimes you're right, sometimes you're wrong. The benefit, though, is not in hiding under the carpet or hoping nobody notices and hoping if we just don't say anything it'll go away. The benefit is to look at what did I miss, what was not accurate in my predictions, because that's how we get better. So it's a tough thing to come here and tell you that I didn't do an accurate prediction, or I didn't make an accurate prediction, but that's part of this game. That's why I will come back and tell you. That's what Uncle Gary's here to do, is not to only tell you how amazing everything is, but when things don't go the way we think they're meant to go, to actually come clean and say what happened. So let's dive a little deeper. I've made a whole series of notes that I'm going to go through to make sure that I cover off all the points, because a heap of stuff has happened since we spoke last about this market crash in December 2020. So a couple of things. The first one was, notably, I made some trades that weren't profitable, and I do want to talk about those because I put about 10 to 15% of my portfolio betting that long-term treasury bonds would go up in price. And that usually happens when the markets go down, treasury bond prices go up. They did not. They have gone down, even lower than before. The second thing that I put some money on was an index known as UUP, which is a US dollar index, which basically I was expecting the US dollar to also rise. I think that's still going to happen, but the hypothesis timing was inaccurate. It did not happen, so I'm underwater on those ones. Now, a couple of other things happened. The first thing, we barely even had, I think in the total of the 2-month period, it was December 7th to February 7th, we barely even had 3 down days in the whole period. In 2 months, we've barely even had 3 down days on the market. The market is on a tear, and good news is good news, and bad news is good news. No news is good news. Everything is just causing the market to go up and up and up. So, a few things I noticed that were worth pointing out. Tesla went crazy. We're over $850 for each Tesla share. And there's going to be even more to share about that. For those of you that heard about what Tesla's been doing with Bitcoin, there'll be a separate video on that. That's a whole separate topic. The other piece, GameStop. For those of you who've been watching GameStop, we're going to talk about that. I did make a video. I'll even post the link up here for a video, and you can see. It might not be necessary to go and watch the video again because you've either heard about it or you haven't. But the point is, we'll talk a little bit about where GameStop has left the market, and then the last element that I will introduce is the property market. Is this had implications for where the property market was going to go? And as fate would have it, the Canadian Mortgage Corporation, the one that insures and underwrites Canadian mortgages for people who sometimes don't put down a full 20% deposit on their properties, that mortgage CMHC, that mortgage corporation, the prediction they made mid last year in 2020 was that the property market would drop by 30%. And wouldn't you know it, they were wrong. Also, literally 180 degrees wrong. Not only did it not drop by 30%, it went up by 30%. So there are a whole lot of people that were speculating and estimating and predicting and hypothesizing that things would go in a direction, and boy, did they not go in that direction. So let's go ahead. I'm going to show you now what happened with GameStop, because I think this is a really key point. A lot of what I was talking about was option trading and people just being excessively speculative in how they were approaching the market. This isn't really what we would call investing. It's more like, without kind of making it a bad thing to do, it's kind of like gambling. And the GameStop phenomenon summarized or highlighted how people were not actually even gambling, they were trying to prove a point. It's almost like trying to trade to establish some sort of justification or some kind of political or social outcome. Like, for those of you that remember the Occupy Wall Street movement, this happened in the late 2009 time frame after the subprime mortgage meltdown in 2008 and 9. And what happened was basically a whole lot of people camped out and went on a very stable and static march in Wall Street, and they basically just camped out and wouldn't move. So this was similar to that, except this GameStop situation happened on the markets. So let me go ahead and switch over to a chart that I'm going to show you, which talks a little bit about what GameStop has done and why this is important. So here's where we're going to look at. GameStop is a stock, as many of you know. They sell as a retail outlet. They sell computer games, and they have done for many years. Many people who are in the 30 and below category remember buying games as teenagers and trading in their games, a bit like baseball cards, but you used to do it with games. And everyone who has fond memories basically saw GameStop getting beaten up by the hedge funds, and they were being what was called shorted. And so they started to buy their positions, and you can see this market kind of went crazy because people needed to cover their shorts from the hedge funds, and this caused a massive spike in the pricing from way down over here in August 2020. It was kind of $4, and then it hit a peak up here of about $350, give or take. Now, a couple of things I want to point out. These E circles over here are the earnings that GameStop actually brings in. So this is their financial results as a company, how they actually perform as an entity. And I'm going to just very briefly walk you through a few of them. If we look at what they said on the 2nd of April, they had the period ending January 2019. And what they told the market was that they reported a negative $1.84 earnings per share. So they lost $1.84 for every share that they had out in the market. The analysts in the industry were expecting their earnings to be a positive $1.58. So they had a shockingly bad quarter. It was 257% down on what the analysts thought it was meant to be. So really, really tough quarter for them. They then went on to somewhat recover in a way where the analysts estimated they would lose 3 cents per share, and they ended up making a profit of 7 cents. So hardly a substantial profit, but at least positive. And the analysts didn't call it correctly, but needless to say, it's not exactly a rosy situation. It went on where they, again, were estimated to lose 18 cents a share, ended up losing $4.15 a share. In this interval, they lost $1 on an estimate of making 11 cents. Again, 1,000% off on the industry estimates. And then they lost... They lost this estimate battle here, where the estimate was they would make 79 cents. They ended up only making 32. So again, at least in the green, but certainly not in line with the estimates of the street. And again, the story carried on. They basically lost 95. They were estimated to lose 95 cents a share, and they went on to lose $2.57. And so the story carries on. They're losing money like crazy. They are not doing well. There's no nice way to put this. As a company, they're grappling with what retail means. They're grappling with why can't people just buy games online. They're effectively a brick and mortar retailer. They haven't fully transitioned to online. So they've got a lot of structural challenges that are happening. Now, the reason I'm telling you all of this is because if you start seeing people buying the stock as if it's the best thing and the most valuable thing, it's unbelievable to me that on January 23rd, the GameStop stock was the most traded stock on the stock exchange. It beat out Apple and Tesla, even though Tesla is 81 times the market cap of GameStop, and Apple is 233 times the market cap of GameStop at that time. So it was massively traded, well beyond what should have been legitimate, and that was largely because of this GameStop Reddit threads around what was known as Wall Street bets. And what the Wall Street bets crew and the Robin Hood kids that I mentioned in the previous video, what they were all talking about was hold the line. They had this very, very interesting phrase called hold the line, which is from a movie. For those of you that remember that movie, it's Braveheart with Mel Gibson, where he's painted in all blue. They're having a big battle scene, and basically they tell all of the soldiers in his crew, all of the people that he's in charge of and leading into a battle, he tells them all to hold the line. Don't move until the enemy is right on top of us, and then we're going to pounce on them. And that was basically what this Wall Street bets gang were doing. Now, the fundamental point of all of this is the stock isn't actually worth anything near what it was being traded at. I think we can all agree that. The point of that is the actual valuation of the stock is usually derived by its assets that it's got. If you broke the company up and stopped it trading and just sold the assets, how much money would you get per share? Or it could be on the profit that you make from the dividends that they would issue. Right now, they're losing money every quarter over quarter for a number of years now. They've been losing money. So there's certainly not like some dividend is coming. So if you own the stock, you may want to buy it, and it might even seem like a great idea. But at some point, you've got to wonder what you're going to do with that money now that you've sunk it into GameStop. And so what most people have been doing was playing what I call the bigger fool theory. And what that means is, I think I'm going to buy the stock because there's some bigger fool out there who will buy it from me. And so I keep buying it, saying as long as I get in and out and I play this odd game of musical chairs, the bigger fool theory or the greater fool theory is really a really prevalent trading strategy. So that's what I wanted to discuss today. That, I think, had a lot to do with why the things we all thought were going to happen are not happening, because there's a lot of this greater fool trading patterns. And again, it's not really investing. I want to be really specific about when we talk about investing, there is some intention to make a long-term gain over a sustained period of time. Not how do you stage a hit and run where you buy a stock and get out and then basically just, have a pocket full of change and then run away. So if you can do that once, twice, that's great. But to do it over 10 years is going to take something. You can't always be a hit and run artist over 10 years. So the last things to bring this back to a point, what ended up happening with the GameStop acquisitions of those stocks at those prices is two things. The one is the hedge funds got extremely nervous. They got called out for shorting a stock. And I do think that the hedge funds, as mentioned, were playing a little bit offside. They shorted more than the amount of stock available. 130% of the stock available was shorted. Now, that's not really fair. I don't think that's transparent, and I don't think that's ethical, but they did that. And then the Reddit, Wall Street Bets kids and the Robin Hood kids all then started to buy against the hedge funds and held back the stock so that they had no choice but to buy back their stock at very, very high prices. And they lost a fortune, well into the billions. So the Reddit kids and the Wall Street Bets kids, they taught them a lesson. I'm not sure that's why I trade. I don't know if I'm in the lesson teaching business. I'm more in the how to invest and have revenue and make a return and do the things I want to do in my life. But I can tell from what they were saying, they were very unhappy. Many of them referred back to this Occupy Wall Street or subprime mortgage where the bankers all got bailed out and the average Joe got basically to lose their money. The other piece about this is when the hedge funds got very, very nervous, they're now very concerned about taking such aggressive short positions anymore because of what's happened. This genie is out of the bottle. You cannot put this back in the bottle now. So what they ended up doing is if a hedge fund gets called out, it may actually trigger it to sell its other assets. So if you're holding a very short position, you have what's known as a margin call, where the exchange or whoever's given you those shares to sell short, they look for you to pay them back. So you've taken out this loan of the stock and now you have to pay some of it back or all of it back. Well, they may have needed to exit the other stock that they own. And what nobody seems to be talking about is that the other stock that they own and their backers are very, very important in the market. I'll be specific. most people don't realize that the biggest funders and supporters and investors in hedge funds are actually pension funds, endowment funds, and all sorts of other institutional funds that people have their 401k retirement funds in, that people have their RRSP retirement funds, their Roth IRAs, their TFSAs. This is where people have invested their funds. So for those of you that invest corporately, you have a pension plan through work, that's where it's being invested. So if those hedge funds have to exit those long assets like Apple and General Motors and Chevron and all of the other stocks that are positive and profitable assets, they would inadvertently cause a domino effect of selling, which could be very dangerous. So the Reddit kids, who were these kids, we have this picture of them being in the basement, and they're these young millennial kids, were apparently sticking it to the man. I'm not sure that's exactly what was happening. The Uncle Gary conversation here, the straight talk, is they may have actually been sticking it to a couple of men, but inadvertently sticking it to their parents who were sitting upstairs watching TV with their retirement fund being put on the line. And I don't think anyone really sees it that way. That's my view. So quite a dangerous thing to do. And it's also going to change the tactics that the hedge funds use. I really don't think that they're just going to roll over, play dead, and say, oh, well, these Wall Street bets kids got us. We can't win against the internet. Oh, well, let's just go home and be broke. I don't think that's how this game is going to work. So they'll shift, they'll manipulate, they'll change. It's going to be a very interesting time, to say the least. But that's the news for what we've seen. The other piece is ethically. There's a lot of conversation that's happened around, was what happened ethical? Was what happened right? Should the regulators now go and regulate, Reddit, Wall Street bets, Robinhood, all of this conversation? Well, what I've seen is over the last 30 or 40 years, at least 40% of the market activity was funds and legitimate investing, and more than 50%, if not 60%, has been rogue traders. You watch any movie about Wall Street, the Greed is Good of Gordon Gekko in the 80s, Mike Milken, the junk bonds in the 80s, Wolf of Wall Street, you name the Big Short. You go watch any movie is made about these rogue, mercantile, absolutely mercenary traders. That's been going on for years. So when a bunch of Reddit user group members did that, it seems a little bit two-faced to suddenly be very upset that people are doing this. The market has been doing this. The big traders have been doing this for decades. So I think it's not exactly unfair. In my opinion, all's fair in love and war as it comes to trading. But it's generally very intriguing to hear how the politicians are suddenly very nervous that the average Joe is now trading. So that's where we are. To summarize, the Occupy Wall Street movement seems to have grown a different head and is now manifesting inside of the trading floor. The bigger fool or greater fool theory is playing out aggressively in the market, and many people were just going along with the crowd. And I'm sorry to say, but for those people, there was no benefit to teaching the man a lesson. The people who bought in, let me switch back to our stock here, the people who bought in over here at 200, 300, 400, whatever the case was, close to 400, well, it's now down at $60. So that stock has fallen close to 80%. I really don't think anybody who lost 80% on that stock, whoever bought at those prices, just got nailed. So all of the people holding the line and believing they're making history and doing such an amazing job, in essence, you were just making a game of musical chairs happen. And some of the poorer, like not poorer, but some of the people who got in a little late, the latecomers to your game, well, they get left without a chair. And, what are you going to do? All's fair. That's how it's going. So I don't think it's nearly as benevolent as it sounds on either side. A lot of people have lost a lot of money on GameStop, and it's certainly not making any stock. So at some point, someone's going to want to say, there's no dividend coming. I kind of need to sell that stock. We can hold it for a few weeks, but why would I just leave the money there? Why wouldn't I go and buy something else? Why would I leave it in GameStop? And when that price comes down, whoever paid those high prices is going to get nailed. And it wasn't just the hedge funds. So that's where we are. I think that pretty much covers off most of what I wanted to discuss. It's been a remarkable time. There is one other point I will raise, which is quite interesting. I mentioned in my previous video about options trading and the underpinning need for shares when trading options. I've discovered something really interesting. And let me switch over to a picture that will explain what I've discovered. Here is a picture of a graph showing the number of call options and the volume that turns into open interest at the end of the day. Now I'll explain that in a little bit more clear terms. At the end of the day, the options traders get a look at how many shares of the underpinning shares do I need to buy to cover the option positions we've sold today. And then they go and what's known as true up, or go and buy the shares that they have in market. Well, the interesting thing here is, as you can see in this little note that I've put there, is they've actually got a situation where people are buying options inside the day. They buy it and sell it inside the same trading window. The options trades are happening intraday, so in the same day, which means at the end of the day, they haven't needed to go and buy more of the underpinning stock. And that was one of the areas that I was mistaken. I did not realize the velocity with which people were trading. It's quite remarkable to actually see that. So this is fascinating to me. The speed with which trading is happening in options is remarkable, because options may not be as liquid as stock. People always think, oh, don't worry, I'll just sell my stock. Well, that requires there's a buyer, and if you stick to the very liquid stocks, you're fine. But if you're sticking to the options, you may get a very severe shock when you realize options can gap down enormously. There is no reason why they drop slowly. They could drop from, you bought the option at $1, you're hoping to sell it for $3, and all of a sudden it's 22 cents. And there's no step in the middle. Someone just says, if you want me to buy it from you, I'll give you 22 cents or 20 cents or 2 cents. It could gap down to nothing in a moment. So very, very dangerous trading activity. I hope the people who are doing it know exactly what they're doing. I am going to be making more videos on options, because this has now become something people think options are like stocks, just more fun and they make more money. They are not. So that'll be another Uncle Gary video. There's so much to discuss. I'm so excited to hear what you're all discovering. And thank you for staying with me. Thank you for allowing me to make predictions, and for allowing me to come and tell you when I'm right and when I'm wrong. Because if I'm wrong, I will tell you when I'm wrong. And when I'm right, I will tell you why I'm right. It's not about pride, or I don't get better because I made a prediction and it was accurate, but I do get better when I understand what informed my decisions. That's how I become a better investor. Thank you very much for watching. It's been a wild ride, to say the least. Look out for the next video, so please like and subscribe if you haven't. And you'll see some videos on Tesla, on Bitcoin, on options. There's so much to discuss. It's going to be super exciting. This is Uncle Gary, and I'll see you on the next one.